I think we can start. Here I'll do my very best not to spoil the whole thing in the very last panel. I have to start saying that I felt very depressed when seeing Michael's slide showing the NPL market in Europe. As a Spaniard practitioner, it was kind of a bit depressing to see where we were and where we are now. Hopefully things will kind of change at some point. I don't know if it will be 2022 or it will be 2023. We will get there. As I chaired the last panel, a very impressive one, with people, I mean, I've managed to work for or against in some cases, like my old friend Rafa. I think we started working quite a long time ago, probably more than 20 years. And we've been in both sides of the table, and it's always been fun. Viktor is from Deva, you know, is part of Santander universe. I've never worked for Santander. I've always tried to stay on the bright side of the force, so always for investors, never for sellers. But obviously, it will be very interesting to see what is he after. Chris has been doing some stuff in Europe, not much in Spain, if I'm not wrong.
No.
We hope to see you more and more in the future in Spain. It will be fantastic. My good friend that has been extremely lucky recently, much more than the investor I was working with, he can maybe explain what is he been doing recently at KKR. And Akis from Intrum, another investor for which I've worked for and against in the past, that is joining us from Greece, if I'm not wrong. And I would say we can maybe start allowing you to introduce yourselves and explain the audience what you've been doing recently. Rafa, if you want.
I work for LCM Partners, which is a credit opportunities fund based in London. We have a 24-year history. We've been in Spain since 2004, initially just in unsecured, but quickly developing into SME and secured debt. We manage basically two main funds, one NPL fund with 4.1 billion, with money from pension funds from the US, North America, and Asia. We also have Brookfield Asset Management as a strategic investor in the company, not in the fund. And in terms of activity, we've been spending quite a bit of time in the UK, in Italy. Spain has been quite challenging this year. The north of Europe has also been quite interesting about doing shipping loans, which is slightly outside of our core remit in the last year, and also trying to push forward our credit, our direct lending strategy, which is working quite well. We have it's a 1.1 billion fund on which we've already deployed in the first year about north of 160 million, and that works with OEMs, different underwriters on customer financing. And I was just looking at, in terms of activity, what we are expect to be closing from here to year end is about 250 million, as I said, mostly in the UK and Italy, and hopefully we'll do the same in other geographies.
Good afternoon, everyone. My name is Viktor. I'm working for Deva Capital, also based in London. Have a chance to cover Deva's NPL business across Europe. We're a young fund, basically established 2 years ago, fully funded by Banco Santander. Basically, the mandate is to look at NPLs, REOs, basically the core distressed business. Also, we're looking at service infrastructure as well as relative special situations somewhere between the NPLs and the servicers. Countries-wise, I mean, out of London, we're covering Europe, out of New York, we're covering LATAM. Europe being a big place, obviously, so we're kind of looking at markets with some strategic angle, looking at deals in mostly Southern European markets and selected Western European, being Portugal, Italy, Greece, looking in France, Ireland. Interestingly enough, we're not doing anything so far in Spain, kind of stayed outside of Spain. We like secured portfolios. We don't really buy unsecured unless it comes in a package. In terms of the asset class, I mean, within secured, we can do granular, we can do concentrated, we can do leasings. I mean, we can do across the capital structures. We like to team up. I mean, we like to team up with the servicers mostly, establishing partnerships across, like services to co-invest and basically have a reasonable skin in a game with us. So that's pretty much about us.
Chris.
Hi, everybody. Good afternoon. My name's Chris Winkler. I'm the CEO of Razor Capital, which is the international arm of our sister company named Absolute Resolutions Corporations in the United States. Through that company, we do distressed consumer asset buying. We're one of the larger players in the United States. As that market ebbs and flows, we at times enter foreign markets. So 5 years ago, we did number of deals with a partner in Central and Eastern Europe. Viktor would know. He was one of our trusted partners at the time from APS. And so, we're exploring the European market now as a potential hedge to the U.S. market. And from what I've heard from the conference from most people, it's a lot of similarities. That product is scarce, prices are high. So really, I'm here looking for what's the next opportunity that could pop in Europe that may interest us.
Excellent. Rohan?
Hi, good afternoon, everyone. I'm Rohan Singhal. I work at KKR in our private credit team, specifically what we call our asset-backed finance vertical. So what that entails is we invest in sort of hard or financial assets up and down the cap stack, really, from one flagship credit fund, along with a bunch of sort of managed accounts, totaling roughly sort of 3 to 4 billion of invested capital over the past sort of 5 years since the inception of the strategy, and growing rapidly since then. In terms of geographies, we're very active in the US and the Americas through our New York team, as well as in Europe and Asia through the London team, given the fund has a global mandate. So more specifically in Europe, we've done plenty in the UK, Ireland, in Spain. We own the servicer Hipoges, as well as made a number of NPL transactions in Spain and Portugal both. And then spending time looking at sort of further markets such as Italy and so forth, hunting for, I suppose, the next great trade.
Excellent. Akis? Can you hear us?
Yes, hi. Can you hear me?
Excellent.
Perfect. Okay, great. Hi, good afternoon. Buenas tardes to everyone. We'll give you, I'm sure everyone is fairly familiar with Intrum, so I'll talk to you a little bit about Intrum in Greece. So give you through this introduction and be a little bit more specific about what Intrum does in Greece. So I am the managing director of Intrum Investments in Greece. Intrum entered into the Greek market in 2017. It has performed a series of acquisitions of both secured and unsecured portfolios. So far, those have amounted to over 10 billion in total claim. Further to that, we've done 6 securitization transactions under the so-called HAPS or Hercules Asset Protection Scheme. That amounts to approximately 16 billion in GBV when you put those 6 securitization transactions together. But also in 2019, we did the first carve out in the country. We carved out from Piraeus Bank, formerly known as Recovery's Banking Unit. We created one of the first mega services, independent mega services in Greece called Intrum Hellas. It's approximately 1,300 people strong today, and it manages over 27 billion of GBV in receivables, for approximately 50 billion in total claims. So we have been fairly busy in Greece for the last 4 or 5 years, and we continue to develop and continue to invest in the country. And of course, we'll always look forward to leveraging experiences from our, say, Southern European markets, both Italy and Spain, of course, and see how we can import some of the know-how and experience from those markets into Greece. Finally, Greece, given its more recent growth within Intrum, has been labeled as a strategic market. So with its peers, Spain and Italy, so the 3 markets are strategic markets for Intrum. So that's a little bit of what we do here in Greece and a little bit of the background.
Excellent, thank you. Well, finally myself, José María Gil-Robles from DLA Piper. As you probably all know, DLA Piper is a law firm, so I'm not an investor. So I'll just be making questions because obviously what you want to know is the point of view of my panelist. And I'll start immediately with Rohan. What keeps you awake at night as an investor?
Yeah, that's a good question. I think there are 2 things, right? So one is how long the beat can keep running, how long the music can keep running, and then the other is what about the stuff we've bought? Have we missed anything? So I think the answer to the first one is, there is a lot of competition in the market. Obviously, my panelists being prime examples of that, and a lot of new entrants in the market as well. That being said, I think there's always a place for sort of patient capital, long-term capital, people looking for, let's say, more esoteric situations, more difficult asset classes which don't fit so neatly inside the buckets maybe of debt purchase entities, for example. We can be more active there. So, sometimes I have some fears there when you go through a quarter, 2 quarters and don't see enough flow or getting beaten in each deal, but generally have been able to come back and come back strong. It's been a decent year for us, to be honest. So been thankful for that. And then on the portfolio management side, I mean, naturally through COVID, right? I think there was a lot of nervousness, my side, on our PM side, on how our portfolio is going to manage through this. What about court backlogs? What about asset valuations? And so far, I mean, touch wood, we haven't seen huge difficulties as yet. The court, there were definitely slowdowns. We did see sort of collections delayed, but asset values have held up pretty well throughout the period. And while that may have kept me awake at some point in the night, I think by and large, for me personally, I'm pretty positive on the sector. Actually, I've got a lot of faith and confidence. There's a lot to do.
You can be. You've been very successful recently, much to my regret.
Much to your regret.
Yes. Chris, what about you?
Europe is a longer ride for us. It takes us more time and more energy to do business here than the United States. So we have to balance that in our, return risk profile. And while I like that the European market by and large has matured since we started here in 2015, it's also become price restrictive for us. And we like the lower prices. We were willing to take that risk on when we were a less mature company. Now that we're a more mature company, we have to look at it, and we generally look at it with partners. I mean, we would probably not get out over our skis and just go into a deal and just buy it and figure out the servicing later. Our objective is to find somebody that has boots on the ground, that knows the assets, that can price the assets with us, that's willing to put money into the deal. And so to us, it's as much about probably building the relationship with our partner here and then proactively deciding, which deals to go after and if we can try to take anything down via that way. When we did most of our deals with our former partner, we were generally a smaller part of the investment. And we thought that was a good way to, enter the market and find some safety and security by going with, pros that have done 20 deals and just being part of those deals. So it worked very well for us. So now this is like the brave new round 2 for Razor Capital looking in Europe. And we're just not jumping into anything immediately. So we're assessing the market and we know that the prices are up. But, with that comes, improved collection tools, improved technology. So the assets could look neutral to how they looked years ago, and maybe they will perform better, and maybe that will justify a higher price. And so we're working through all that currently in today's market.
Rafa, what about
yes,
you?
I would say that probably in the current environment, sometimes what keeps me awake at night is winning a portfolio. It's like, it's been me, winner's curse. But teasing aside, I think, we've been going through this cycle, for a few times already. Sometimes we have new money coming in, we have investors with different views on the market, and it's fine. I think, it's just a question of what's your appetite for certain risks, and all of us appreciate or favor certain situations we feel more comfortable, we have a better understanding of the asset, of the servicer. Specialization is a theme that works well in the current environment because there are certain things that you really appreciate better, and you can tell your investors that this is what you do best. Other than that, I think it's fine. I think there's going to be plenty of opportunities. Timing of them might not suit us all the time, but I think there's plenty of opportunities on the secured. There's a myriad of situations. When you speak to the financial entities, they're reviewing their capital charges on all across the board, asset classes, client segments, and I think there is time of opportunities. I wish it could have happened sooner, but I'm optimistic side.
Do you agree, Viktor? Same views?
Well,
others?
Pretty much same views. I mean, we have a luxury of having no backlog, so we don't have much of the pre-COVID pricing and whatever worries. Also, we have a luxury of basically starting in a times when yes, demand is there, but also supply is increasing and will be increasing. We believe we set out our strategy properly. We've got patient capital. We like amicable solutions, but asset-backed. So we need to understand the core value, and then I believe we sleep well. So far, we've deployed around 300 million, which I believe in the last 18 months, including the pandemic time, is a reasonably good achievement. And we just stay patient. I mean, I believe in the industry we're in is only going to grow.
Okay. Rafael, going back to you, I mean, how do you see the market next year? Because this year is pretty much a disaster. So what about next year? Do you see a healthier market, or we will have to wait until 2023?
Well, I think we might have to wait. I think the overarching sensation is that there is a lot of thought being given at the institutions on what to do about the situations. They're still trying to read the tea leaves, so to speak, about what is going to happen. I think it was mentioned yesterday in the panel. Institutions want to have channels, they want to have choices, they want to have alternatives. And at least what we are trying to do, this type of conversations that we're trying to engage, is being able to provide a holistic answer to some of the opportunities. And that's why, in our case, having a single-digit fund that can address performing or reperforming portfolio situation is useful. Even we could go as far as to do a wide-level funding certain client segments. It's something that we've done in the past. We took on BBVA's consumer finance portfolio in Italy when they exited. We did the same with the SME and leasing from Fortis in the UK. And I don't think that we are going to see yet entities, exiting certain segments, but clearly they're rebalancing their appetite, and I think there is a conversation to be had. NPLs will continue. The driver is more, of course, the moratoria and the impact on certain sectors. In general, we tend to shy away from a strong concentration in different industries. So, we still need to read, the type of portfolios that will be coming to the market in Spain. But, part of the answer as well is diversification geographically. I said, we've reached a JV in India where we expect to deploy money. We're expanding more into Eastern Europe. We're revisiting appetite for the Nordics. As we discussed, we always have a lookout for Latin America or elsewhere, which, how much of that is going to yield into actual investments, I don't know. But it is not a time to sit idle.
Excellent. Akis, what about Greece? How do you see the market? Do you agree with what the previous panelists have assessed, or you see things differently?
No, I think it's pretty much aligned with what the other panelists said. However, there's potentially a little bit, specifically to Greece again, it's probably a little bit, not as mature, right, in terms of what has happened in the other markets. In Greece, as you all know, we had a big NPL problem. It continues to an extent to being big in comparison to our European peers, in comparison to other markets. However, the banks have done, I would say, a fairly aggressive job in the last 4 years to be able to reduce the leverage from the balance sheets, the bad loans. Companies such as ourselves, Intrum, but others, in this particular space, have supported, the market in order to deleverage and the Greek banks to deleverage. Currently, the Greek banks their NPA ratios are, if you combine the systemic banks or the larger ones, they expect to be lower, the NPA ratio lower than 20%. And their overall goal is to be single digits by end of next year. So through a combination of asset sales and a combination of securitization transactions under the Hercules protection scheme, they've been able to achieve these. And hence that's continuing on. The question about us here is now a little bit about what's next, what's in the future, what lies ahead, right? In some of the more mature markets, there's been the development of NPL secondary markets. Here it's something that it hasn't developed yet. It's starting. It's in its very start, and hence we're thinking about what's next, what's the future. Of course, we continue to monitor very closely. And to your earlier question about what keeps investors up at night, obviously it's performance on the investments that we've done, right? So that's what really keeps us awake at night. And continue to monitor with great precision, if you will, the investments, but also are very much into alertness of what's next, what's coming up in the pipeline, so that we can continue to build our book, but also at the same time also ensure to adjust to any potential market trends, and hence the NPL secondary market that I was referring to, when that eventually develops for us here in Greece. So a number of different things, but generally speaking, very much aligned with what prior speakers said.
Okay, Rohan, do you agree with Rafa? Are we going to do we need to be patient? Or we may see more activity next year?
No, I think that's right. The wave of NPLs that everyone has been talking about coming out of COVID has been slow to materialize, and I think will be slow to materialize. I don't think it's going to be the cliff of a sudden avalanche that sort of flood the banks and NPL ratios shoot up. I think it's likely to be sort of a slow-growing wave that comes through maybe sort of second half of next year into 23, as moratoria wear off, as some of the sort of other measures taken to help the borrowers start rolling off. You'll see some slight rise over there, particularly probably more on the SME side is what we're expecting at least. I think the consumer is actually in a reasonably robust position and not in the same place as they had in 2012, for example. So I think it's a patient game. The banks are still going to be generating NPLs as is a natural part of the business. So there'll be the usual suspects, the big banks in Iberia and so forth. Will be continue to sort of sell the books, secured, unsecured, SME and consumer, and will continue to be active. But it's going to be enough to go around. But it's going to be a competitive market still. It's not going to be the flood of supply, in my view, that people may have been thinking about in the depths of COVID a year ago.
Okay, Chris, Viktor, in which countries do you think you are going to be busier in the short term? I mean, you're going to be spending more time?
It's interesting because, just as Rohan was speaking to, people thought we were going to have the pandemic, then there'd be this avalanche of debt. We were all going to have a heyday with lower prices. We were going to be able to buy deals in any country that we wanted. And when I take a step back and look at it, I feel like, these countries did a really good job of managing the financial situations. So they're much more mature and much more prepared than they were, after the great financial crisis. So it is a different ball game. If I had to pick a country, I think that would be challenging for us to say right now. It's going to come down to where we see enough volume to get my behind on a plane and fly over the ocean and meet people and create that partnership with the servicing. But the challenge that I see to it yet is that these banks are also healthy now, and especially our U.S. banks. There's just no motivation from anybody to sell anything because the banks did not have this big fall off from the pandemic, and everybody went and got enough money to pay off all their bills. The deposits at the banks are crazy. Savings rates at banks are crazy. Businesses were saved, that could have folded, have been completely propped up and will continue to be for some time. So that's where I see the challenge is that, the sellers may not be motivated unless they can really get that high price, and if they're getting a price that's so high that they're selling in this environment, that gives me pause to how I want to attack this market.
Viktor?
Well, I mean, I tend to agree with what was said, that there's not going to be any massive change in 2022 vis-a-vis this year. I mean, probably the post-COVID kind of wave exactly will come kind of gradually second half of next year and then hopefully kick in more in 2023. And next year, I mean, we believe will continue being busy in Italy. We build up a good position there, hope to capitalize on it. I mean, there is a huge transaction in Greece to come. Secondary market is opening up there with Arios, with basically portfolios being sold out of the older hubs deals. Portugal will deliver a steady flow as it does. I mean, the volume works for us. I mean, the deal sizes are right for us. Also, Ireland is building up I mean, there's a nice resi pipeline coming out. Amicable solutions are what we like. So, I mean, we hope to be busy across these countries.
I mean,
And also see to open up again, I believe.
I remember in the previous crisis, I mean, all the banks were pretty much saying exactly the same they are saying today. There was no rush. They were fine. I remember Mr. Zapatero, I mean, asking to be invited to London because, I mean, Spain had a lot to teach to the rest of the world in terms of a healthy financing system, and suddenly that was no longer the case. Hopefully, we don't travel the same. I mean, we don't find ourselves in 2, 3, 4 years' time. But let's see. What type of assets are you going to be seen in the market? I mean, unsecured is easy because it's fully provisioned, and I think it's pretty much all that has been traded so far this year, but at least in Spain. But in going forward, I mean, what do you expect to see? SMEs, mortgages, performing, reperforming. I mean, what do you think is going to be the asset class of 2022 and 2023?
I do think, if I can take the word, that banks will consider performing and reperforming. Whether that's going to take the route of securitizations or straight sales or hybrid forms is, you can see different banks trying different models. We're going to make our pitch on, what are the merits, of course, of a true sale or, some sort of synthetic product. But, we want to buy assets. And I think that there will be an element of that. SMEs, we're still trying to figure out how the post-eco world is going to work out. We do think that there is a shortage of operational capabilities to deal with the micro restructurings that the SME fabric needs to have. And that brings opportunities. And there are servicing capacities, there is investor appetite. You just need to make it joined up in a way that works with the banks. And I don't get the impression that that has been figured out. So that's work for us to bridge that gap in expectation. But we're going to have to wait until something is resolved. There's some regulatory decisions and how to work with it. And the rest, I would say resi mortgages. The underwriting has been far stronger in the recent years. So, while I do expect a pickup, yes, I don't think that we're going to see the huge volumes that we've seen in the past.
Any of you disagree? Expect the same type of assets?
I'm interested to see where the secondary market goes to, and I'm surprised that we haven't seen or heard more about that with, people searching for product as it is now. And you can learn a lot from secondary markets by seeing who did what and who's willing to give up a position. And, sometimes it can be for good, sometimes it can be for poor. So I'm interested now that the overall European market develops to see how that part of the market develops and where the opportunity could be with that. And then, that type of exercise is almost completely gone in the United States now. When you buy something from a bank, you buy it and you own it for life, till death do your part. And you'd have to sell your company a lot of time to exit positions. So it's a different dynamic where, it's also a hedge where you can buy things here. And if, you don't get the return that you're expecting, well, you still have a different exit on the assets. So I'm keen to watch and see what happens in that arena.
If I may comment on Chris's point, and sorry if I'm stealing the thunder. On secondaries, we've seen far too many that have not transacted when there's been competitive bidding, and we've seen the data tapes, and we've seen how performance has not always been up to standard. And a little bit of the elephant in the room is that a lot of some competitors have not always met the return expectations. We've also seen on the listed entities that they've been doing write-downs on investment in Spain, which, and that's the listed. The non-listed, all of us have, some portfolio that has not delivered. So I think that there's still a bit of reckoning that needs to happen before we see a more steady flow of secondaries. Because right now it's more the last option, and as long as the person that bought that portfolio is it's not going to happen.
Right.
Yeah. Have you, I don't know, Akis, Viktor, Rohan, been successful trying to take portfolios from other institutional investors?
From our side, we've looked at a few secondaries in the past. To your point, Rafa, where we really struggle is the execution probability, right? The risk of no trade, not just your competition from your fellow bidders, but then the risk that you don't meet the reserve price from the fund. So there's always this maybe skeptical question mark. Maybe I'm overly cynical, I don't know. But there's the question mark in my mind, which is, are they looking for a real process? Are they being opportunistic sellers because it's a seller's market at the moment? Are they looking for a mark in their funds that they can then show to their investors and then move on with no transaction? We've seen honestly too many of these processes come about, which undermines confidence to then honestly to spend the time on the next secondary deal, which is kind of to the detriment of the rest of the secondary market, which is unfortunate, but that's kind of the way we've seen it so far. So from KKR side, we actually generally don't get too involved in secondaries for now. It's been more on the primary transactions, unless there's a particular angle or reason that we can see to build execution confidence. That's been the hurdle so far for us.
And to be fair, on our side, we have not also considered in that much depth secondaries as a way to rotate the portfolios, which we should as well. Sometimes it's not always that there's a bad performance, it's just that you are too busy trying to deploy capital to consider other strategies.
Yeah, exactly. Certain portfolios, for example, can be quite mixed in nature, right? So some portfolios which we may digest will come from banks and have a large portion of unsecured. We as KKR are not great unsecured NPL buyers. It's not really our focus or our target generally. So maybe the likes of LCM, for example, might be better placed for some of these things. But therefore we can look to these things. We haven't done too much in the past yet. We're buy and hold investors by and large. But there are opportunities where a secondary can make sense as long as you can build a robust enough process with the right advisors, with the right bidders, and the right confidence that it can lead to a transaction. Then it's worth spending time.
And from our end, we're selective in the secondaries. You need to understand the motivation of the seller. You need to be well positioned. Ideally, you work with the incumbent servicer. Hence, you build up some advantage and understanding. And the motivation is the key. If it's coming out from GACs or hubs because they have to bridge the gap to avoid deferrals, motivation is clear. Also, exactly the advisors at the sell side. If the advisor is proper and runs the benchmarking for, and basically the pricing for a seller, then you trust the process more. So being selective.
Akis.
What I can add to this is also, I think very much aligned with what Viktor just said, right? It depends on the source, it depends on the motivation of the seller. Of course, all investors have a different reason for investing, right? We all don't have aligned interests. At Intrum, for example, we are a servicing company and we do investments as well. And hence, many of the investments, not all, but many of the investments that we do is to also support our servicing arm. And, we obviously leverage our servicing arm to deliver on the returns that we're looking for. And hence, we also at that, from that perspective, we also like to control the servicing or control the investment that we have done. So from that perspective and tapping into the secondary market, if the price is right, if the asset is right and it's workable, then we're also very happy to engage into that market from an investor perspective. But going back to what Viktor said in terms of the source and where these potential NPL portfolio sales in the secondary market come from, or I should say maybe just portfolio sales, not necessarily NPL portfolio sales. It has to do also with these different schemes, the GACs, the HAPs, because those have to. You have to accelerate your collection effort in order to align with specific performance events or triggers, or to avoid triggers, and therefore you or the servicer has to conduct portfolio sales in order to avoid unhappy situations, if you will. Hence, there is a certain motivation to sell and sell fast in order to avoid performance events. So. Now, what comes out of these, typical securitization transactions? I would say, in what we have seen on the ones that we have done here in Greece, is that you definitely expect, your so-called RPLs, or restructured performing loans, that they're, the same systemic banks would have an interest of buying back those loans from the securitization entity. But also investors who have a specific niche and act as a bridge to the banks who may want to get some more comfort in terms of time of performance. And so you have several investors that play into that. Then you have your specific NPLs out of those NPLs portfolios, securitized portfolios, but clustered in specific asset classes where you have niche investors who specialize in those assets. And therefore can have interest in those. And then finally, REOs, these, from executing liquidation strategies with these securitization transactions, the inevitable is taking over collaterals, and these collaterals eventually become REOs, and then you need to dispose these REOs. A one-by-one effort takes time, right? And having the proper workout in place, but in order to again accelerate and be able to provide liquidity to the waterfalls. From real sales, you can bunch those up, and you can do real portfolio sales as well. So a number of different opportunities coming out of these securitization transactions, and I see that I see that secondary market. Although Chris was mentioning earlier that in the US is something that is fairly dead. I think that is very active in Europe. We expect it to be very, very active here in Greece. And both from an investment and servicing perspective, we look forward to engaging into that.
Okay, let's talk a bit about the reperforming or superperforming spaces. I mean, it sounds like the next hot market. Is there a risk of becoming overly crowded? I mean, I can hardly find investors nowadays that do not want to give it a try. But I mean, there are not that many opportunities. Will there be, or we will see, like in Prometheus, I mean, dozens of investors trying to get some piece of action there? What's your take?
I think from my side on the RPLs, I think it's right. It's a very attractive asset class, and there's a lot of money chasing them. There will be more flow, to your point. The banks will see some more of these sort of deterioration in performance as some of these moratoria wear off. For example, there will be some of these books which have more storied performance, if not NPLs, things which are a little bit more complex, a bit more hair and a bit more juice in terms of yields, right? Which makes it a bit interesting when everything else is trading with very tight yields and underlying mortgage pools have exceptionally low sort of coupons or yields from the products. Then need to look to other spheres. I think the tough part with RPLs in particular is the sort of pools of capital that can transact in such opportunities increases as well. Depending on the size of the opportunity, generally you can start looking at sort of insurance money as well as the more traditional credit funds that might participate in such deals, and that can that can distort the market. That can make sort of investments relatively difficult for those which don't have access to such sort of cost of capital. And that's going to be potentially a challenge as we see some of these pools coming to light. But I do think it will be a feature coming out through 2022 and 2023, not just in Iberia, but we're seeing the same in the UK and Ireland as well. Plenty of mooted portfolios that have either been released sort of late this year or coming to market next year.
Okay.
If anything to add to that, I think tell me a segment that is not crowded already, so competition is there. I guess the one difference that you might see in that segment is given the ticket size and the sensitivity to default that some of the new entrants, insurance money, I don't know how hard skin they've got to withstand difficult situations. Whereas we are more, if you will, on the grown-up space, so that certain portfolios will not perform, and we're more used to that. I'm not sure about some of that new money. How they will cope, with a difficult cycle.
And in terms of a type of transactions, do you see a different market in the future than the plain vanilla pure sales that we've been seeing, with some attempts to sell by way of a securitization? Or, do you see banks prepared to be more flexible in terms of considering different type of structures, or not really? In your discussions with banks, have you seen them willing to simply sell, or do you see them open to explore alternatives like the ones you have in the US?
Things have almost gone into slow motion. Like there hasn't been a structural change to how you do deals. There hasn't been contract changes. The one of the things that we were going to talk about is the ESG. You're seeing more of that. That is coming to light. You have to have that policy. They're starting to check for it in audits. But the banks couldn't even come on the premises last year. We're having our second seller audit of the year. And normally would be a dozen of them where they come in and do their audit on site. So I think there's too much unknown. And again, people aren't in the office, so they're not motivated to make contract changes. They're not motivated to find new sellers. Everybody's just kind of doing what's in front of them and what's easy in my experience, of what we're seeing in the United States on deals. And then when I've looked over here, I haven't seen anything new jump out at me that, is like, oh, we need to set up a new entity in country X because, there's a new way to do a deal and we want to get in on that. To me, it looks, like I said, almost like slow motion. From where we were. I remember leaving Lisbon March of 2020. And at that time, we had ideas for going to Portugal. We were looking at things in the Far East, and it was like, boom, it just stopped, and so nobody knew what we were expecting. You had to kind of stick to your knitting and, make sure that the base camp was solid. And then, for us, it's now we're slowly starting to peek out a little bit here and there and see, what could come next.
Yeah, same here. I guess not much of a dramatic change to come. Securitizations were super instrumental in basically moving two huge markets, right? Italy and Greece, and kind of created opportunities then for a secondary and basically moved the NPLs out of the balance sheet of the banks. There'll be some continuity of GACs, as is always. Akis is better placed to talk about hubs 2 and 3 to come. But things are going in waves in Greece. So now probably the wave of hubs, there was a big one this year and last year. Probably we will fade away for a bit. So in my view, there will be a combination of plain vanilla and securitizations. The RPOs talking about before, I mean, this is a asset class which basically calls for securitization. So probably this will attract the attention of debt structures.
Yeah,
sorry.
The only point I was going to make, giving the argument back to you, the innovation is happening on how you transfer economic risk, the tax structuring, but not so much in terms of economic enhancement. I think as Chris was saying, banks are going more for the plain vanilla. There's so much competition, and there are little space to negotiate. So yeah, I'm not expecting much on that front.
And what about regulation? Do you see more coming, or things staying as they are? I mean, are we going to be seeing in more places rules on how to treat customers, to deal with them, or we shouldn't expect much changes there?
I think not even regulation, just the expectation of the seller is increasing so much. So the sheer compliance, we're having client audits by the seller in the UK, where they are telling us not only whether we were complying 5 years ago with the process, with the existing regulation, but whether we were anticipating the future changes, so we would anticipate and improve the process when we didn't have to. And I think that is in the current political environment is not going to decrease. And I think it's not only a question of process and operations and IT, but also about the culture, how much convinced you are that is the way to go, rather than lagging behind. So all of us need to embrace that. We need to incorporate that into the cost of the deals, which is something that is not easy to do. I would say that we're going to see surprises.
Same, Rohan?
Yeah, no, I think that's right. I think there'll definitely be sort of increased focus, and we've seen it in a number of processes, especially on things like data protection side, GDPR, and a number of processes where banks have, by necessity, sort of implemented sort of restrictions on during sale processes, for example, which makes it honestly a lot more onerous to go through the sort of the NBO and binding offer process and trying to evaluate these portfolios. It is a necessary part of the work, but makes it even more sort of necessary to then have boots on the ground, to be honest, to have a local servicing partner who you can trust to go into the bank, to test their systems, to review all the files you can, because it's increasingly difficult to get the documents out of the banks, to be honest, to be able to do the diligence that you want to. I think there needs to be a little bit of, let's say, rationalization on how GDPR interacts with some of these processes and what data is necessary for underwriting versus what is obviously sort of truly personal data, which isn't required for these sale processes. But the burden's only getting higher, and the barriers will only get higher. So it's something that we all have to manage. It's just going to keep going.
Akis, what about you? Have the same feeling?
Yeah, pretty much the same feeling, but as the guys were saying earlier, the transactions, when you do the securitizations, these transactions become to be fairly, fairly complex, right? And then when guaranteed by the government with certain requirements, and then you pretty much have to stay on your tips of your toes, if you will, for throughout the duration in order to deliver the returns. But what the expectation is mostly, I would say, is that more plain vanilla deals, not anything as complex. And very much aligned with what Viktor was saying earlier in that respect. Don't expect anything that is groundbreaking, if you will, or anything unlike what we have seen in the past.
Okay, I think we have not much more time ahead. A couple of questions about things that have been mentioned the last couple of days. This one for Viktor is inflation. Is it a concern to you, or doesn't bother?
It's a good question. I mean, it is a concern for me. Probably not short term, or I mean, it's not tomorrow. But I mean, as one see the inflationary pressures being pushed from the bottom, right, from the cost side, this is basically difficult to fight for any government. This takes down decreases the income of the households, the income of the companies, will ultimately end up in decrease of the recovery rates. So it should be a concern for us. And I mean, obviously, it creates opportunities. It will, I mean, if in case it results in the increase of the interest rates at some point, it will have an impact of the returns. So I mean, I believe any sensible investor needs to kind of start thinking of whether the status quo will remain and how long, and what the change will bring.
Chris, what about you?
Just kind of along those lines, I look at this, my easiest comparison, and something I'm quite interested to see what happens in Europe is the unsecured collection practices and the staffing needed to, appropriately collect these very large deals that could come out. So you have a lot of people that aren't motivated to go back to work, but we're having a very revolutionary time going on in distressed consumer collections in the United States. We have the first update to federal regulation that's going to be implemented here like this month. So there's new rules. We are working under more compliant, but there's what we call the digitization of collections. We're finding new ways to contact consumers, or finding more profitable ways to contact consumers, or finding more ways to be more efficient so you can cut your costs and collect more money. It'll be interesting to me to watch what happens with all these new technologies and streams that we've seen recently in the US. I'd like to start seeing and hearing how that impacts the service teams here. So that's where I'm kind of watching to go along with, yes, money could be more expensive, liquidation rates. The consumer might have less money, they might not be able to pay, but we may be able to get at them or be more efficient in what we do. So I'll be watching that here.
Okay, final question. And talking about servicing, I mean, it's what about that consolidation that never happens, that everyone assumes that it will take place at some point? When are you going to be selling? It should be probably in a couple of months, right? That you should start the process. I mean, how do you see that market? Do you think that, as someone said this morning, this is a mature market and inevitably will come, or it should be pretty much nothing happening in the coming months, because every country has, the servicing capabilities that it needs. And this is for any of you.
If I start off, I mean, from our side, I think there is a strong argument for servicing consolidation, but it really depends on which sectors and which spheres, right? For us, I take HippoChest as an example. The growth in the growth in the platform is exceptionally strong, and we don't see sort of a strong reason to, let's say, pay the sort of strong goodwill, for example, to other platforms where we believe that, and I'll obviously say this, we think our platform is best in class. I think there are arguments to sort of look across the value chain, to expand geographically, and then maybe distressed opportunities with certain businesses which may come under fire and may need some sort of structured solutions in whatever guise that might be. But right now, for us, it's the market's going up, and we're pretty happy to keep going with it.
So it's official, 2 months from now.
Yeah, 2 months.
Okay. Rafa, what about?
I should say that we as an industry were quite resilient because you can argue there are different situations even in Spain. What is going to happen after the post-Sareb contract should trigger some sort of movement. There are news, some of the players restructuring the debt. We have the situation in Germany where the new regulation on the incasso fees will likely trigger some consolidation as well. Some of the debt, or the mixed model debt purchasers, servicers are under stress because they enter the cycle highly levered. They haven't bought that much. They have expensive or large operations rather to maintain. So you put that in the mix, that should yield some sort of movement. But yet it doesn't happen. So And last year, there was a flurry of investment bankers coming to you, offering you, look at the bonds, look at the equity, look, the shareholding structure. And, these are difficult operations to pull out. And the synergies are not obvious. In our case, we are more than happy to take on assets. And we have the capacity of taking, we've taken runoffs like Icon here in Spain 3 years ago. So we can do that. It's not the preferred route. But, we are on the lookout.
I mean, on point, my expectation is rather than consolidation, the more natural sort of route is rather sort of outside buyers coming in and acquiring their own services on the ground. I think it does provide an investor like a lot of leverage, a lot of ability to originate assets, a lot of ability to build confidence in entering in principal investments in the market. So I think that's going to be a more natural route and a more sort of ongoing theme that we'll see in the coming years. Albeit there will be some distress situations, which I think should result in some consolidation at some point.
No, I cannot agree more. I mean, the combination of having a servicer on the ground with a strategic alliance or stake in just gives you way better reading of the market, way better underwriting, and more resilience. Just a sort of thicker value chain. So, I mean, on our end, this is the part of our strategy, and we're looking at different options.
Akis, I guess that you agree, right?
Well, yeah. And if I could use Greece as an example again, several years ago, and prior to the economic crisis, there was a banking crisis. There were more than 25 banks, say, operating in Greece. Now we have 25 licensed services operating in Greece. Of course, there was some rationalization over time, right? So now we have 4 systemic banks operating, and then we have another couple who are non-systemic, which are fairly large for market standards. Say a regional and a few cooperative, right? So I expect that some of that rationalization has to happen also in the services, right? It's natural. I think it's part of the, say, I guess Darwin's law or survival of the fittest or whatever, right? So I think that some of the rationalization will have to happen, even from the 25 licensed services today. There are 3 mega services, we're one of those, and then there's many others who are big and small in different sizes. Of course, there are some niche ones, right, that specialize in specific asset classes, and those have a niche, and they will, they are not there to become a mega servicer. Of course, there's always the opportunity that lays for investors to come in and buy a servicing unit and buy a large portfolio or buy a series of portfolios and establish their own presence in the market. That's always, of course, there, and hence I agree with the guys that said that earlier. So I think it's a little bit of a combination thereof, but definitely rationalization or consolidation is something that will eventually happen. So it's either consolidation or eventually extinction as well, right? So that I'll say that's a natural. I guess it's a natural tendency over time.
Excellent. I think I believe we've run out of time. I don't know if there is any question from the audience to put forward to these gentlemen, or it's maybe a bit too late and everyone is too exhausted. Okay, if there are no questions, I think Guillermo, it's